welcome back traders and investors to Benzinga's pre-market prep. We have the 920 interview with Paul Mladjenovic, the author of Stock Investing for Dummies and The Raving Capitalist. Paul, how are you? Welcome to the show.
Oh, it's a pleasure to be on your phenomenal show. And it looks like we'll have some great opportunities for 2015.
Yeah, hopefully it's going to be good. I mean, we got it's as much as uncertainty is something that traders and investors don't like to have. It does offer profitable opportunities for those who are perhaps repositioning or rebalancing portfolios. So, what do you see coming up for 2015? I mean, we've got all sorts of central bank action to start the year off. We've got a bunch of problems in the precious metals industries. We've got oil collapsing. I mean, what do you think is going to happen in 2015?
Well, you know what's quite interesting? I didn't get a chance to mention it in the pre-show, but I was on a different program the other week, and I talked about how there were some high-profile pundits out there who were given an amazing range of forecasts. There was one who was mentioning he sees 31,000 Dow in the next few years, and another one who was a hell of a lot more bearish, looking at 6,000 Dow the next few years. And I think no matter how you slice it, the bottom line is this. What's going to make stocks go up or down, of course, is going to boil down to the buyers and sellers out there. More buyers, the market will go up. More sellers, it'll go down. So, pretty much rudimentary, right? So, but the point is there are titanic forces in play that are going on right now. And I think that and I have things I'd love to say for both investors and speculators. I think that, the volatility will probably get even worse in the coming 12, 18 months. I think without a doubt, because there's a lot of money moving in and out like lightning. On the bullish side, you have forces like the Federal Reserve who continues to plow with the easy money going into the stock market and some of their member traders there. And you also have the thing that money might be coming into the U.S. markets from overseas, when there's money fleeing because of a lot of the instability and the economic weakness that's going on over there. The U.S. economy has basically the chance of being the best-looking house on a very bad-looking block for the most part. So those are the bonuses. The problem with the U.S. economy, though, is, and I think one of the glaring things that happened in the past week, which I thought was really quite interesting, was that the head of the Gallup organization mentioned how he thinks that the 5.6 the unemployment numbers is basically a lie. And I was shocked. I wasn't shocked that it was a lie. I was shocked at thinking, what took him so long to figure that out? So the thing is that a lot of people in the U.S. markets are being very bullish for a lot of reasons, but I think that the underlying weakness is just going to cause some spectacular volatility to the downside. And with the Federal Reserve being involved, I think maybe the biggest issue for 2015 is moral hazard. Ultimately, I think you're going to see some sharp pullbacks, I think some really bad pullbacks in the next few years for a variety of reasons. But in the meanwhile, you're going to see days like yesterday where without a huge reason the market will go up. So for speculators and traders, I think it's a good opportunity for people to do, and I know that you're very versed in a lot of the trading, so I think they're in good hands. Listen to you being a guest host. I happen to like, for speculators and traders out there, a specific trade where they might want to take a look at something like, say, the QQQ, which is, as you know, the NASDAQ ETF. Mm-hmm. And, consider maybe putting on, start dabbling with some long strangles. And for those within the sound of our voice who may not know what a long strangle is, it's like buying an out-of-the-money call and an out-of-the-money put, on the same security. You could do a straddle, but that's very expensive, when you buy calls and puts at the same strike price. But a strangle is a little bit cheaper to do, and it's a little bit more doable without speculating with a lot of money. And for those people who don't know what the purpose of a long strangle is that you're going to take advantage of a huge market move, but you don't care whether it's up or down. All you want is a big move. And I think that there's some opportunities. And if the volatility is tremendous, they might have a chance to make a profit on both ends. In other words, when the stock market soars, they might be able to cash out the call at a profit, and if it crashes, very quickly thereafter, they might make money on the put side of it as well. So, for those out there, again, this is for speculators. For those people who want to jump in and jump out, I think that's not a bad trade to deal with.
So, Paul,
all right? And give me your questions before I take up too much of the airspace.
No, I like it when you're going, because you're saying all kinds of great things that I kind of want to ask you about or touch on. So we were talking about moral hazard. We were talking about relative value, and the U.S. is the best house on a bad block. this decision from traders and investors to anchor themselves to either the current or at least the memorable past, and their decisions to just kind of follow with the flow. If dollar's strong, you sell gold. If unemployment's rising, yields are down. Does this make you feel trapped at all if you're stuck just investing in? It's almost like picking the lesser of two evils, because you're not really it doesn't seem like investors and traders out there really have anything strong or of incredible value in order to get exposure to. We're just picking the least bad to get into, and it seems like nobody really has intrinsic valuation anymore. Do you ever feel trapped with the choices?
I think the intrinsic valuation which you're mentioning, I think this is maybe the glaring hole in what a lot of people are doing these days. I mean, the point is, it's a lot of momentum investing. It's counting on what the crowd is doing, and then not going back to the fundamentals. I mean, there is value in this market, but I agree with some of the studies out there, including the Schiller study, where the PEs seem to be at sky high levels. There's a lot of money flowing in there, and I think a pullback is going to be a very serious issue. Now, keep in mind, if you're buying quality, and you have a long-term perspective, and I wouldn't sweat the volatility. We have to remember, in 2008 when the crash occurred, you had situations where both good stocks and bad stocks were plummeting tremendously, but the good stocks came back, and so people have to come back to the basics and understand, don't be buying stocks, be buying the companies. They're not doing enough analysis on companies where they're having the growing sales and the growing earnings and the rising dividends. This is where I want to be. As a matter of fact, there are lots of great, for example, dividend ETFs that actually give good individual opportunities. I mean, some of the great dividend ETFs that are out there, people forget you can take a look at the top 10 or 15 positions in there, and that gives you a good starting off point to see about what you want to do. You want to have stocks with the rising dividends because the money will ultimately flow there even in the wake of a sharp pullback. But for people out there who are speculating with the Twitters of the world, etc., no, this is where you're making the mistakes of the past come to light. You got to be back to the basics where it'll be a much safer play for you in due course. You won't be wrong in the long term. But for those who are 6 months away from like retirement or whatever, or they have rent money, they better be putting in their trailing stops and developing some cash positions, because when these companies do come down in price and the companies are still solid, they'll have cash on the sidelines to buy some buying opportunities and maybe even lock in phenomenal yields. People forget that in 2008, 2009, when some of the quality companies came down who were dividend payers, that gave for people who were not, trying to hide in the hills away from all the devastation, they had a chance to be stepping in and buying quality companies with sales and earnings where they were able to lock in dividend yields of double digits, like 10 and 12 and 13%. So I think that when there's a sharp pullback coming down the pike, people have to learn from past history and say, this is a chance to go in and buying quality companies in this regard. So there's opportunities for investors and traders in this market, but I think, I am very wary because I think it's an overheated market, and the pullbacks, I think, will be much more dangerous, and the day is going to come when the Federal Reserve will not be able to step in. It's like the people who keep on jumping out of a window, always expecting a trampoline. At some point, that trampoline won't be there. So they better have cash on the sideline and have some hedging positions on as well.
Paul, I couldn't possibly agree more with that, because I take a look at the margin credit levels that we have in this country, and I know everybody tries to compare margin level, margin credit to the, the equity markets, but what I look at specifically is the borrowing of it. And it seems like right now, with the dynamics of how margin credit actually, takes place, we have people right now who are basically borrowing to go long the market, and this almost creates a base whenever there's a whole bunch of selling in the market, because these shares are being, borrowed or held. Nobody's doing anything with it. But it seems like as soon as the market starts getting a hiccup and the Fed raises rates, these brokerage dealers aren't going to like the rate that they're getting on their margin credit. Therefore, they're going to issue calls. And that's where it seems like this is going to come wicked quick. And you seem to notice that also as you talk about, the appreciation in asset prices, which I'm sure we could agree that it was done by the Fed. And then also the excessive PE levels, thanks to, buybacks and also, again, asset inflation. So it seems like we're kind of setting ourselves up for a major correction here. The hardest part is trying to time it. So if timing's a difficult thing, what do you take exposure for? I mean, what's your view for the next 6 months? Do you prefer precious metals over equities or something to that effect?
Well, first of all, in another venue, since you mentioned it, and by the way, I think that, the people who get rich in a market are always going to be the people who are going to be courageous and be the contrarians in the crowd. Mm-hmm. You know what I mean? when the first half of 2014, when oil was so ebullient, you have to figure, look, if you buy a few dirt cheap puts, the most you're going to lose if it's a few $100. But if you're correct, you can make a few thousand or more. You know what I mean?
Mm-hmm.
So people have to not be with a herd mentality if they're going to be doing the trading. Now, on the investing side, what do? You always seek value. You know, the precious metals have had a rough ride the last few years, but you're getting to the point where, look, more and more you're finding out that behind the curtain that there's diminished supply to a tremendous level. I think that my favorite speculation for the next few years is going to be silver, because people keep on forgetting they're adding on more and more uses, and the thing is now the price is technically below. I mean, a mine might as well close down all their silver mines and just go to the futures market and just buy up all the contracts they can. They'll save money and they'll save the wear and tear, on their workforce. So I think there are some great long-term benefits there, and people have to also remember that whenever they're looking at the political crises, and the issues of the day, define buying opportunities. Like I still love biotech and healthcare, but I avoid the health insurers until they figure out what they're going to sort out in that area. I mean, when you hear that there's like hundreds of thousands of kids crossing into America and they're bringing diseases and we're not doing what we used to do. I mean, I'm an immigrant, by the way, but if I had a communicable disease, they would have shipped me back to Yugoslavia, which is no longer there, by the way. Talk about a collapse, but that's a different story altogether. But the thing is that when you have a booming need for, you hear about measles and Ebola and all the rest, and more people out there, So for me, I see long-term fundamentals in things such as the healthcare sector, but more or less like the biotech and the technology and like supply realm, like the Johnson & Johnsons of the world or whatever. And again, like we always do, we tell people, make sure you speak to your financial advisors about some of the specifics mentioned in this. But no, the opportunities will always be there. But you know what? If you're 100% directional, you're going to get slammed, especially with this kind of volatile market, and surprises will be coming. So I'm expecting those.
What do you? Because we were just talking about the healthcares and some of the issues there. What do you think about like fiscal policy in the U.S.? I mean, if the U.S. is the best house on a bad street, what does our fiscal policy look like on a global level? Do you see any sort of issues coming with the way that the federal government is operating and the way that they're managing their expenses? Because I was talking earlier with Kevin Kelly just before you came on, and we were discussing interest expense and some of the problems that are brought about when central banks lower rates. That governments need to spend more money, they need to take on more debt at a shorter maturity for a lesser rate. Does this would this play in at all, do you think, to how you would view healthcare or even view the U.S.? How much does fiscal policy play into the decision making on your end of things?
Well, on the fiscal side, this is both a Titanic and a glacier. It will cause massive problems, but when you hear about the can being kicked down the road, that's going to continue. I think the real weakness in that is going to be is that, when you look behind the numbers and why all the spending's going on, you have record levels of people who are now dependent on the federal government. You have record level of people who are basically unemployed. I mean, like 93 million the last time you said, which means a lot of those went from getting unemployment benefits to getting disability benefits because they really loosened the rules for who's disabled. I guess you have a headache, you can get disability. But the point is, that doesn't augur well. A lot of the profits and the revenues have been getting the last few years is because you have a finite segment of the economy which has been making the profits, especially in the financial markets, and you're having some record levels of revenue from things like these capital gains and all the rest. But at other levels, it's extraordinarily weak. So fiscal policy is not going to have a material effect on the financial markets in the next three weeks or 3 months or 6 weeks or 6 months. But there will come a time when the Federal Reserve will have to start, doing some bailing out here, and there will be coming a time where the weakness will be so bad that, a lot of the lending to the United States from other countries is going to start drying up. Because people forget, the U.S. dollar may be the king out there, but the point is, the cracks in the system are happening. You see places like China are aggressively seeking to try to get at least parity with the U.S. dollar, which means that you're going to have a hell of a time with being able to loan out to the world. You're going to have a hell of a time maintaining the fiscal policy, and you're not going to get that revenue back until the economy gets a lot healthier, and it won't be a lot healthier until some of the restrictions coming in aren't loosened. I mean, people still know a lot of things are happening right now that haven't happened before. The Obamacare penalties are going to start kicking in. There's going to be a lot of restrictions going on. You're going to see more and more companies, closing the doors on places where they can't afford anymore. When the minimum wage goes to higher levels, more and more stores close because they can't afford it. They can't make enough of a profit. So this is a Titanic for sure, but it's in glacier mode, and the cracks will probably start appearing sometime next year.
Geez, sounds like a good time to go bury my head in the sand. I mean, if this is the best house on a bad block, and that's the situation, we're in for a lot of pain going forward here. And it seems like we're getting anchored to some of the ways that we responded to these to these economic crises. It's the new normal is now to always have quote unquote the Fed or mom and dad always coming in to kind of save the day for the kids that are just messing everything up.
Well, I think one of the positives what occurred when people saw the election results of 2014, when it was a massive swing, to me, I happen to like gridlock, by the way. People forget that during the 1990s, what made that economy so great, that there was gridlock. You had, both the Democrats and Republicans kind of off-balance each other, so there was like a minimal amount of damage, so to speak. I hate to put it that way, but, but you have those conditions now. So the point is that if some of the brakes and some of the moderation kicks in from both sides to keep a lot of these things from trending in the wrong direction, I mean, and they start to remove some of the things that are holding back the U.S. economy on the labor levels, et cetera, and so forth, you could start seeing, I mean, a good groundwork for a nice rebound. But I'm like, until I see it, I have to be much more risk adverse going forward.
Jeepers creepers. All right, well, Paul, I appreciate you coming on and talking with us. Ladies and gentlemen, we've been talking with Paul Mladjenovic, the author of Stock Investing for Dummies and the Raving Capitalist. Paul, that was a fantastic conversation. I enjoyed chatting with you, and hopefully I'll have another time soon enough. I wish you a good weekend and good luck this month, eh?
Hey, continued success to you and the audience. Make it a great year.
All right, cheers, Paul. Thank you very much.